Certainly you've heard that over time, the stock market's average annual rate of return has been about 12%. While that may sound like a steady and reliable place for growing your retirement savings, this is the truth. Let's visit Macrotrend's website at www.macrotrends.net and view the S&P 500 90-year history chart. We'll uncheck the inflation-adjusted box. After all, when you retire, nobody's going to adjust your savings for inflation. Okay, that looks like some steady growth. But wait a minute. Why is the space between 10 and 100 the same size as the space between 100 and 1,000? And the same size as the space between 1,000 and 10,000? That's not right. Let's uncheck this log scale box to create an even scale. Yikes! What happened? Well, that doesn't look very steady. In fact, it looks like the S&P hardly gained anything at all until about 1980. And since then, well, I've seen some roller coasters that look like that, and I won't ride them. While the S&P 500 is a major indicator of stock performance, it isn't the only one. Let's look at the history of the Dow Jones Industrial Average. Click on Market Indexes and select Dow Jones 100-Year Historical. Again, we'll uncheck the inflation-adjusted box. See, right here is the stock market crash of 1929 and the Great Depression. Again, we'll uncheck the log scale box and, wow, it looks just like the S&P 500. In fact, the stock market crash of 1929 is hardly a bump compared to what we've experienced since 1990. Well, let's take a look at the NASDAQ. The NASDAQ's only been around since 1971, and it's been home to many technology stocks. Recent performance sure looks a lot like the tech bubble of 2000, when the NASDAQ lost 78% of its value by October 2002. While Wall Street claims a 12% average return for 90 years, the last 35 has actually been a wild ride, not a period of stable growth. The size and the frequency of market crashes has increased exponentially, and by all indications, it's ripe for another one. It's not an appropriate place for Americans' primary nest egg.